Welcome back to the deep dive. Today, we're going to get into the fundamental plumbing of modern finance.
The invisible stuff.
Exactly. The complex, often unseen systems that, make digital banking, real-time payments, all of that possible.
Yeah.
If you use a fintech app, you are relying on this.
Oh, absolutely. And frankly, understanding it is the shortcut to understanding the entire future of finance, the old way. I mean, building a financial institution required you to construct this proprietary technology tower from scratch.
That sounds exhausting.
It was. And now, you don't have to. Our mission today is really to define this foundational layer, the one that lets everyone, startups, big companies, deliver financial products without building that massive tech stack themselves.
I just outsource the complexity.
That's it. And the result is radical speed and scalability. If you, the listener, are wondering how new firms can compete with legacy banks almost overnight, oh, this is the answer.
So we're going to break it down into three core pillars: banking as a service, API platforms, and of course the cloud platforms.
Right. So let's start with what drives all of this. Modularity. The old era was all about closed systems that didn't talk to each other. Now it thrives on open connections.
And when we say open connections, we have to start with API platforms, the digital connectors.
They're the language, They let different systems securely share information, start a transaction, verify an identity.
For the on-ramps and off-ramps.
Perfect analogy.
Mm-hmm.
In the U.S., you think of companies like Plaid or MX. Their whole function is API-based data connectivity. They let a budgeting app or a loan provider access a consumer's banking data.
With permission, of course.
With explicit permission, yes.
But it's not just about viewing the data, though, is it? It's about what you can do with it.
Exactly. It's about utility. Accessing that data is how you underwrite a loan in real time or verify funds instantly for a payment. Without that API layer, the apps just, they don't work.
So they connect the slick new front end to the often very old back-end banking systems.
Precisely. Now, that brings us to the second pillar, banking as a service, or BaaS. This is where the really heavy lifting happens.
Okay, so break it down for us. What are these providers actually selling?
They are selling the regulatory and operational license to operate, all wrapped up in a nice, tidy tech package. They're the bridge between a fintech and a chartered licensed bank.
So if I'm a new fintech, I don't go get my own banking license.
No, you partner with a BaaS provider who already has that relationship with a sponsor bank. This lets you issue debit cards, process payments, manage compliance, all of it. All without the huge capital and time it takes to become a bank yourself.
It sounds like there's a little bit of regulatory arbitrage in that model.
There is. And that's where the risk and the value live. Companies like Synapse, Unit, Stripe Treasury, they manage this complexity. When you put money in a fintech account, the funds are often in what's called an FBO account for benefit at that sponsor bank. The BaaS provider just manages the subledger that tracks your balance, but the actual regulated money is sitting with the bank. The real challenge, and where the regulators are looking, is making sure the BaaS provider's tech is robust enough.
So the BaaS provider becomes the key point of risk control. They're doing the transaction monitoring, the identity checks, all of that.
They are. And this leads to something critical they offer: compliance as a service. From KYC when you sign up to AML monitoring on every transaction.
Which frees up the fintech to just focus on the customer experience.
That's the goal. Let them innovate on the product.
Okay, and finally, none of this works without the raw power from the third pillar, cloud platforms.
The computational spine, AWS, Microsoft Azure, Google Cloud. They provide the data storage, the security, the analytics, everything needed to operate in real time. Legacy systems just can't handle the volume.
But isn't that a huge consolidation risk, relying on just three major providers? What happens if AWS goes down?
That is the constant tension. On one hand, the cloud offers incredible resilience, with data centers all over the world, far better than what a single bank could build.
But on the other hand,
it creates a systemic concentration risk. Regulators watch this very closely. Banks and fintechs have to prove they have multi-cloud strategies to avoid being locked in, but the cost of that is huge, so dependency is still very high.
So the mechanics are APIs for connection, BaaS for regulation, and cloud for power.
And compliance as a service, wrapping it all together. That's the engine. Now let's look at how that engine is built differently around the world.
Okay, let's start with a really successful model. India. The story there isn't just commercial, it's a national policy.
That's right. India's fintech boom is powered by what they call digital public infrastructure, or India Stack.
It's a public utility.
Exactly. Unlike in the West, where it's all private, India built the foundational layers for everyone. They have Aadhaar for identity, UPI for instant, free payments, and a consent layer for data.
So what's the impact of a choice like that?
It just dramatically lowers the barrier to entry. Fintechs don't have to solve for identity or payments. They just build their products right on top of the India stack. It's why India is arguably the world's most advanced digital ecosystem now.
Now, compare that to the US model, which is so different.
Completely different. The U.S. system is fragmented. So many regulators, no unified payment system like UPI. So the infrastructure there grew to solve that fragmentation.
That's why BaaS is so vital in the US.
It provides clarity in the middle of all that complexity. And it's why companies like Plaid had to innovate so much just to connect all those different banks.
Okay, what about the UK and Europe? The driver there seems to be regulatory mandate.
Absolutely. Open banking, the PSD2 directive basically forced banks to open up customer data via APIs. That regulatory clarity just accelerated everything. Cloud migration, new payment solutions. The infrastructure there is really optimized for data portability and security.
And then there's China, which feels like it's in its own universe.
It really is. Its infrastructure is driven by these massive, vertically integrated platforms. Think Alibaba and Ant Group, or Tencent and WeChat Pay.
They are the infrastructure.
They are. The concept of BaaS is different. The tech giants just absorbed all that complexity themselves and integrated payments, credit, everything right into the user's daily life. They kind of bypass the traditional banks.
It's the platform consuming the financial utility.
That's a great way to put it.
And regionally, what about a place like Singapore?
Singapore has positioned itself as the hub for the wider Asia-Pacific market. Its infrastructure is built on a strong regulatory environment and, crucially, cross-border connectivity.
Which is so important in a region with so many different currencies and rules.
Exactly. So Singapore-based providers are masters of multi-currency accounts and digital trade solutions, connecting all these different markets.
And finally, let's look at emerging markets, which are sort of leapfrogging the old systems.
In Africa, the infrastructure is often built on top of mobile money ecosystems, like M-Pesa. Providers there focus on interoperability between mobile wallets, agency banking. It's very pragmatic.
And Latin America has just been exploding recently.
It has. Latin America, especially Brazil, is being pushed forward by these really ambitious open finance frameworks. It's driving adoption of BaaS and API platforms with a big focus on digital identity to bring huge cash-based populations online.
So you see this global pattern. Infrastructure really molds itself to the local
The
needs.
regulatory and demographic needs of the market, absolutely.
That's a fantastic global picture. So let's talk about the payoff. What are the actual measurable benefits of all this?
The benefits are pretty immediate. For firms, you're talking faster time to market, way lower operational costs, and much more resilience.
And it democratizes competition. New players can actually challenge the big old banks.
It forces innovation on everyone. And for consumers, the payoff is obvious. Faster onboarding, real-time payments, financial journeys that just feel integrated.
And you mentioned it can actually help financial stability. How so?
Well, by standardizing the plumbing, you standardize the risk controls. When a few sophisticated BaaS and cloud providers are enforcing consistent compliance rules, you reduce the systemic risk that comes from hundreds of different institutions running on their own old, unmonitored tech.
So you're centralizing risk management at the utility layer.
In a way, yes. It's more predictable, more monitorable.
Okay, let's look ahead. Our sources point to 4 huge trends. Let's start with the big one. The evolution from BaaS into embedded finance.
This is the natural next step. BaaS is moving beyond just helping fintechs offer bank accounts. It's about enabling financial services to operate invisibly within non-financial sectors.
So finance stops being a place you go.
And it just becomes a function that's there, integrated into the checkout flow or the workflow of a business.
That's a huge shift. What's the second trend?
The combination of open finance and AI. Open finance will connect way more data, mortgages, insurance, pensions, and AI will be the layer that makes sense of it all.
For what? Better fraud detection.
Much better fraud detection, more accurate risk models for lending, really granular customer profiling. It moves finance from being reactive to being proactive and intelligent.
Okay. Trend number 3.
We're going to see entirely new infrastructure layers, things like tokenized deposits, digital identity frameworks, and programmable money.
Programmable money. That sounds revolutionary.
It's a complete rewiring of how settlement works. Traditional finance can take days to settle. Programmable money is designed for instant settlement and automated workflows. It's a prerequisite for truly seamless, global embedded finance.
Which leads right into the final trend, global interoperability.
It has to. As commerce becomes global, the finance has to follow. The future is about cross-border APIs and shared cloud architectures that connect these different regional ecosystems we talked about.
So to summarize our deep dive, these fintech infrastructure providers, they aren't just supporting digital finance, they are the backbone. They're what's driving the innovation and shaping how every major global financial ecosystem works.
Absolutely. If you want to grasp the competitive landscape for the next decade, you have to understand this utility layer.
And I think that leads us directly to our final provocative thought for you, the listener, to think about.
It does. If we're really heading toward a world where financial services become completely invisible infrastructure, just seamlessly embedded in retail, logistics, healthcare, what new systemic risks emerge?
When you're not regulating a bank, but a global utility.
Exactly. How do national regulators enforce standards when the financial transaction itself is just a background function run by a handful of global cloud providers and BaaS platforms?
When finance is everywhere, the challenge of oversight becomes exponential.
It's a total paradigm shift for governance.
Food for thought. Thank you for joining us for this deep dive. We'll catch you next time.